Welcome to episode 3 of our asset class overviews. Today, Paul Fichet, our Chief Investment Officer at New Road Capital, is going to continue speaking about bonds and credit. Thank you for joining us today.
Thanks, Jess.
So, last time you mentioned how the capital of a fixed rate bond fluctuates with interest rates. And is that what people often refer to as duration? And maybe can you elaborate more on that?
Yeah, so duration or modified duration in this instance is essentially exactly that. It's to say, well, how much does a bond's price move relative to interest rate movements? So I mentioned before in the previous episode that, if you have a fixed rate bond and interest rates went up, the capital price would have to drop to compensate the investor to buy that bond, because that investor could go to the primary market and go and get a bond with a higher rate. So now, because that investor's in the secondary market, what price should that bond trade at? So it will trade at a low price. Essentially, duration is a calculation of if that interest rate moved up 1%, what value, capital value, does the bond reduce by? Or if the interest rate reduces by 1%, what capital value does that bond go up by? So if you have a duration of, let's say, 2, that essentially means that for every 1% interest rate movement either way, you'll get a 2% roughly move in capital. So if the modified duration is, say, 5, you get a 5% increase or decrease in capital for every 1% decrease or increase in interest rates. Generally, how it works is your longer term bonds, fixed rate bonds, will have a higher duration, because you can think about it intuitively. If you are due coupon payments every year for 10 years and interest rates went up by 1%, when you discounted all those future coupon payments back to the present, you would have quite a lot lower capital price that you'd pay to compensate you for that extra 1%. So the duration would be a lot higher. Whereas if it's only a year out, the duration would be a lot lower. So as a rule of thumb, you can think about it that duration, it's not quite accurate, but as a rule of thumb, duration, essentially you can think about it as the term of the bond. So if a bond has a maturity date of one year from now, it will have a duration more or less 1. If a bond only matures in 10 years from now, it'll have a duration more or less of 10, for example. As a rule of thumb, it's not quite exactly like that, but more or less.
All right, and then bonds have different credit ratings. Can you maybe elaborate a bit more on that and how that affects the price?
Yes. Oh, sorry, just to add maybe one thing other to what I was saying before is in credit. So because I mentioned credit, actually the interest rates fluctuate, so they're not a fixed rate. Credit, because the interest rates fluctuate and it's floating, actually has a duration of 0, because the price is not impacted by the interest rates. The interest rates move in line with interest rates. So the capital price there, it'll move for other reasons, but it won't move because of interest rate changes. So a fixed rate bond will have duration, as I mentioned. A floating rate bond essentially has a duration of 0. To answer your other question, so how do credit ratings affect the price? This comes into corporate credit more. It's more important for corporate credit is obviously if you say, well, I'm going to issue money to Sasol, for example, as I used in the previous example, and Sasol has a very good credit rating, I am willing to take on less interest because I know that I have a better chance of getting it back. If Sasol's corporate credit rating reduces, obviously then I feel like as an investor I'm going to have less of a chance or more risk in not getting those payments back to me, which means that I will demand a higher interest rate. And that's essentially where you get credit spreads, for example. So if you say, well, a corporate is more risky than, say, a government, because a government can essentially print money to pay you back. A corporate has to rely on its balance sheet, for example. There might be a spread of 2%. But let's say that the balance sheet of that company, for example, weakens, and the corporate credit is reduced, or the corporate credit risk rating reduces. I'm actually going to want more. So there, the capital value of the bond will drop, even though interest rates have stayed the same. The capital value of the bond will drop because me as an investor to buy that bond, I'm going to want more interest for it because I feel like I'm taking on more risk. This can also happen with sovereigns, for example. So South Africa, when South Africa gets downgraded, for example, that means that investors are less certain that they're going to get their money back, which means that they want a higher yield for taking on that risk of buying that bond and essentially lending to the government. So to kind of sum up in a nutshell, you can get fluctuations based on interest rates, and that is essentially modified duration. So on a fixed rate bond, you can, as a rule of thumb, think of that as, the duration is essentially the time for the bond to mature. On a floating rate credit, the duration is actually 0 because the interest rates will move to compensate for that. And then the other thing that can move prices on both sovereign and credits, sovereign bonds and corporate credit, is the risk rating, the credit risk rating. So a rule of thumb, if the issuer has a lower credit rating, you're going to want more interest. And if it has a higher credit rating, you're going to want less interest because you feel like you have a better chance of getting that money back. Yeah.
All right. Well, thank you very much for joining us. And thank you for watching. And please watch next week as well.